I know this very this should do that, but not how big the pricing. But yeah, he did this happen actually. Wild how this and then he's but if you try to yeah.
Okay, a couple of logistical details for next week, which is, of course, you're going to be a week from hell. Monday is your final project. It's due. You can do whatever, as you notice my format, you can do whatever format you want, but here are the two requirements. One is keep it short, keep to the page limit. I'm going to be reading not just the project reports from this class, corporate finance, undergraduate class, collectively, probably 6,000 pages of project reports. And I would love to tell you that I'm going to stay engaged for all 6,000, but my engagement level drops off as the number of pages increases. So try to stay within the constraints. Don't spend your time telling me measurement details like this is how I got the debt to equity, this is how I levered the beta. I kind of trust you on those things. So make this about your company, make this about your valuation and pricing. And whatever format you use, send me the final report as a PDF file. Part of the reason it's easier for me to put comments into a PDF file than Word or PowerPoint or whatever. So even if you decide to present it in PowerPoint or Word, send me the file as a PDF file. And no Excel. Don't send me Excel attachments with your actual valuations. That ship has already sailed. So I'm not going into the Excel spreadsheets. So just send me the kind of, so keep, as I said, I'm looking for the story page for your DCF valuation. That tells me everything I need to know about your valuation. That's about it for the project. The final exam obviously is a week from Wednesday. It's from, I think, 1:30 to 3:30 is, I think, the time. So basically 1:30. I'm trying to get a second room because this room will get awfully crowded when everybody's here. Like every seat is taken, there's not much room. So I'm trying to get a second room so that you have a little more room to stretch out, but that's, it's still in process. Getting a room in the finals week, it turns out to be much more difficult than just reserving a room. So that's about it. Let's pick up where we left off. Today, there'll be no start of the class test because when we get into the acquisition section, the test is actually embedded in the presentation. Talk about the value of financial flexibility. Okay? Well, generically, it sounds like a great thing. We all want to have financial flexibility, but I want to structure it as an option. So I know this payoff diagram is one of the most difficult ones I've ever devised to actually try to explain, but let me try. So here's what financial flexibility means. You actually borrow less than you can afford to. You have excess debt capacity. And if I ask you why, you say, well, I'm going to keep that debt capacity to take future investments, acquisitions, projects that might come along. The value of doing that, though, is not the project itself. It's the net present value that comes from that project. So you're preserving excess debt capacity to take projects that might come along in the future. Unanticipated. They're anticipated, you can set aside the money. Unanticipated projects. If those projects come along, you're going to use your excess debt capacity to take those projects and earn the excess returns. Is it possible that you set aside excess debt capacity and none of these projects show up? Absolutely. In which case, what have you lost? whatever it costs you to keep that excess debt capacity. So let me start by putting a number on that, because that'll tell me how much I'm giving up to preserve financial flexibility. I'm going to take you back to my 1997 Disney optimal capital structure. Those of you in my corporate finance class, of course, you know this gets updated. In 1997, Disney's actual debt ratio was 18%. Their optimal was 40%. At their current debt ratio, the cost of capital is 12.22%. At the optimal, it's 11.64%. So this seems like a slam dunk, right? Go to the optimal, lower your cost of capital by 58 basis points. So you tell me to do that. And as Disney, I push back. I say, look, we'd like to preserve that excess debt capacity in case a great acquisition or a project comes along. So I know you're giving up 60, in this case, the difference between the 12, so the 58 basis points a year to get that. The question is financial flexibility worth more or less than the 58 basis points? If it's worth more, then I'm going to say keep the excess debt capacity. If it's worth less, I'm going to push you to try to borrow more. So to value that financial flexibility as an option, I need the input. Again, I'm going to go through the process of trying to get S, K. Seems like mechanistic, but unless I convert a real option to inputs, I can't value. David? Yeah. This one, okay.
But so if you go for the optimal, which is 40%,
yeah,
then the higher you go, the higher your cost of debt as well. So
that'll always happen, right? Borrowing will always push up on cost of equity and cost of debt. It's a weighted average that matters.
Yeah.
Here's the trade-off, right? Debt and equity both get more expensive as I borrow more money. But when I borrow more money, I'm replacing more expensive equity with cheaper debt. So initially, that trade-off works in my favor, having debt be cheaper than equity. But eventually, the rise in both kind of overwhelms me, which is one reason why there's an optimal debt ratio. Now, where I hit that would vary across companies. But in this case, it was at a 40% tipping point. So here are the inputs I need to value financial flexibility as an option. For the S, I need expected reinvestment needs. What goes to it? CapEx, depreciation, acquisitions. S becomes that as a percent of the value. I'm going to state everything as a percent of value because my cost of capital is stated as a percent of value. For the variance in that, it's the uncertainty I feel about future reinvestment needs. So it's not just that I have high reinvestment needs, but that they vary across time. For the strike price, I essentially have to come up with how much I can come up with internal financing to cover that. So if I can come up with a lot of cash flows internally, then I value financial flexibility less. So K becomes a measure of how much do I throw off as cash flows. And finally, I'm going to do this on an annual basis because then I can compare it directly to the 58 basis points. As I said, incredibly messy option. But if you plug the number through, it turns out that the value that I get for financial flexibility on an annual basis is 85 basis points. I don't like to talk in basis points. That's fixed income language. No, so if you prefer 0.85%. What do I give up to get this? 0.58%, which is the difference from going to the optimal. At least based on these numbers, it looks like Disney should not borrow the money. For those of you in my corporate finance class, I've given you an escape hatch for the, if your optimal debt ratio is much higher than the current as to why you might choose to hold back if you're Adobe or Google from going to the optimal. As with all of the other real options, I can almost promise you will never value financial flexibility with a full option pricing model. But this model actually gives you some insight as to what kinds of firms should value financial flexibility. We make three propositions. The first is more capital constrained firms should value financial flexibility more than others. You know where it's going to show up? That K, which is the exercise price, how much you can raise. If I push that towards infinity, basically you're saying, no, I don't need the value of the option. So in traditional corporate finance, remember, you can access as much capital as you want. I don't need to bet financial, it loses all value. But if you take that capital constraint and dig down deeper, emerging market companies should value financial flexibility more than developed market companies because they have less access to capital. What does that mean? Emerging market companies, I would encourage to stay more under leverage than developed market companies because there you want to keep that excess debt capacity. Private companies should value financial flexibility more than publicly traded companies. So we have two companies which look equivalent, but one is privately owned and the other is publicly traded. They both have the same optimal. I would expect the private company to be more underlevered relative to its optimal because pushing towards the optimal, you give up more. Second, it should depend on how unpredictable your reinvestment needs are. Remember that sigma squared? If I make that 0, the value of financial flexibility disappears. A regulated utility has no business talking about financial flexibility because they should know how much they're reinvesting over time. A technology firm is on much more solid ground saying, I don't want to borrow money because I don't know what the next year is bringing. I understand why the Googles, the Facebooks, and the Apples stay underlevered. You can take every one of them, you can compute the optimal. Some will be underlevered by a lot, but they're all underlevered. Because you're in a business where everything can change dramatically, you should value financial flexibility more. And thirdly, and this to me is the dividing line. Ultimately, the value of financial flexibility doesn't come from a capacity to take projects, it comes from a capacity to take good projects. In other words, if all your projects have 0 net present value, stop talking about financial flexibility. Why would I care whether you have flexibility or not if the best you can do is deliver an NPV of 0? So in businesses where you can earn well above the cost of capital, I would value financial flexibility more than in businesses where I cannot earn my cost of capital. An airline, if they say financial flexibility, I'm going to shut them down right there. So I don't care how unpredictable your future needs are. You can't take a positive net present value project. Why would I leave you with excess debt capacity or cash? In fact, with emerging market companies, not only might you stay underlevered, so instead of at 40%, you might go to 10, you might go to 5, you might go to 0, you might even go to minus 20. How do you get a negative debt ratio?
More cash.
They just hold cash. In fact, if you're in a really volatile emerging market, you might choose not just not borrow money, but accumulate cash because for you, the value of financial flexibility becomes so immense. So if you take nothing else out of that, that alone might be useful as, which brings me to the final application of options. And this is the only option you have a shot of trying out on your company. No, yeah.
Sorry, before
Yeah.
we move on the debt side of things, so doesn't matter the way you raise debt, is it through bonds or through borrowing from the bank? Does the method of recapitalization
Give you less or more flexibility? Is that what you're?
Yeah.
I think that they both take away flexibility because you can't use that debt capacity again. With debt, you get an additional constraint. In addition to not being able to borrow money, they might put restrictions, covenants. So given a choice between those two, bonds are usually less, take away less from your flexibility than, but you might not have a choice. You might be able to borrow only from a bank, especially in those emerging markets we talked about.
And when we're deciding on reaching the optimal debt to
Yeah.
cap ratio, then how do we decide which method of raising debt should one consider?
Ultimately, what do you want to, if there are 3 different ways and they yield a cost of debt that's different, you want to go with the lowest cost, right? So that's the first thing. The second is if you truly value flexibility, that's got to be a second factor. So if a bank lends you money at a lower interest rate, but takes away, adds covenants that you don't want to live with, you might go with the bonds, even though they have a higher rate. So those are the 2 factors you're going to consider: cost and flexibility. And most important, you want to match up your debt to your assets, right? You don't want to deviate too much from that.
So it depends on the market scenario. There's no set formula.
If there were, ChatGPT could run the company, right? Again, be glad that there is no set formula, that it is subjective. Make subjective a good word. This is what's going to bail us out, is we're subjective. We make sometimes things, you say, where did you go? I pulled it out of my rear end. That's good. ChatGPT can't do that, right? I mean, so the things that we complain about that, that's subjective. Those are the things that you want to kind of work on because that's what's going to keep you in the quiet.
Going to the last lecture, but why having no debt means the option doesn't value?
It's not that the value, no, I didn't say the option.
I had asked you about my company. I said, oh, they value it as an option.
Liquidate, let me cover that. That's the last, so as I talk about this, you're going to see this. Now, go ahead. Okay. Let's talk about equity as an option, right? Let's go back to the definition of equity. Equity is a residual claim, right? You get whatever's left over after everybody else is paid. And if you liquidate a firm, take me through the process, what happens? You take the liquidation proceeds, you pay off the existing lenders, and whatever's left is yours. And who gets to make the decision on whether to liquidate? The equity investors, you can optionally liquidate a firm. You don't have to be forced in liquidation. So there are two components here. One is equity is a residual claim. Second is equity investors run the firm. And let me bring in a third feature if you're an equity investor in a publicly traded company. You have limited liability. What does that mean? If you don't have enough money to pay off the lenders, they can't come after your house, your car, your personal assets. Those things are going to come together in thinking of equity as an option. So here's what I'm going to do as my payoff diagram. You're the equity investors, you run the business. You can choose to liquidate at any time. If you liquidate the firm and you get a value that's greater than the face value of the debt, you get to keep it. If it's less than the face value of the debt, say, sorry, guys, that's the most you can get and you walk away. The limited liability is critical. So you might not want to use this in valuing a private business where you're the owner and there is unlimited liability because you might think there's optionality, but then your personal assets are going to be taken. I'm going to use this as a device to talk about all kinds of things that range from corporate finance to valuation. So I'm going to start with a very simplistic example, and I'll concede it's simplistic. Let's assume you have a firm whose assets right now have a value of 100 million. So if you liquidate today, let's say you'd get the 100 million, but there's a lot of variation in that asset value. So the standard deviation of that asset value is 40%. So you got value of the firm, 100 million, moving around. Let's assume that this company has a face value of debt of 80 million. So if you liquidate, you got to pay the entire face value. And it's a 10-year zero coupon bond. In a minute, I'm going to ask you why I made it so structurally constrained. Why a zero coupon? It's a 10-year zero coupon bond. So what does that mean? You owe nothing for the next 10 years. And the end of the 10th year, you got to pay 80 million. The 10-year bond rate is 10%. So I've given you the value of the assets with the standard deviation. I've given you the one debt they have, a 10-year zero coupon bond with a face value of 80 million. And I've given you the 10-year bond rate. I'm going to argue that with that very limited information, you should be able to tell me how much the equity in this company is worth and what interest rate you would charge on the debt. No betas, no cash flows. And here's how we're going to do it. We're going to think of the equity as an option. The underlying asset is the 100 million, the value of the firm, because you get to run it. If you liquidate it, it's a liquidation option. If you liquidate it, you're going to get 100 million. That becomes the S in the model. If you liquidate it, you got to pay off the face value of the outstanding debt, 80 million. You have 10 years to play this game. Now, do you see why I made it a zero coupon bond? Because for the next 9 years and 364 days, the lenders can do absolutely nothing, right? Because you don't owe the money. We'll talk about what will happen if this were a 10-year coupon bond, but this is a 10-year zero coupon bond. The variance in the value of the underlying asset is 0.4 squared, which is 0.16. And the riskless rate is 10%, SKRT and sigma. Right? So SKRT and sigma, I should be able to plug it in, get D1, D2, N of D1, N of D2. Let me pause right there. What did we say N of D2 is? The probability that S will be, and in this case, what's S? The value of the underlying assets will be greater than the debt I owe. So there's a 63% chance that my assets will have a value greater than the debt, which means there's a 37% chance. So what do we say in finance, at least, when the value of the assets is less than the debt you owe, we're technically bankrupt, right? There's a 37% chance of bankruptcy. There's an outfit called KMB. It's a West Coast-based outfit, where if you're a bank, you can take a loan portfolio and they estimate a probability of default on that. They use an option pricing model, the N of D2. It's a much more complex model, but the N of D2 becomes their probability that they can give. So there's a 37% chance of bankruptcy, but the value of the call option is 75.94. You know what the call is here, right? That's the value of your equity. If the value of the equity is 75.94, the rest has to be debt. Because remember, the value of the entire firm is 100, 24.06. It's a zero coupon bond. So if I know the value of the debt, 24.06 in the face value, I can back out the interest rate on the debt. The default spread here is 2.77% over and above the risk-free rate. There's another set of research where people have used option pricing to explain default spreads on bonds. So instead of the rating, they say, And for at least very, very distressed debt, it turns out that this model gives you a better estimate of the default spread you observe on the debt than using the rating to come up with the default spread. But by viewing it as an option, I've broken down the value of equity. So I want somebody to track my equity because I'm going to start changing things around to see how the value of the equity and the debt will be affected as I change the characteristics. But is everybody comfortable with the, so essentially from this very limited set of data, I've given you a probability of default, 37%, the value for the equity, the value for the debt, and the interest rate you would charge on the debt. So let's say you buy my equity, 75.94. You wake up tomorrow to a catastrophic event. Your company had two factories, one in California, one in Florida. You take your pick, hurricane or fire, and or earthquake, pick your, either way. One of your factories is completely destroyed and it's uninsured. What's happened to the value of your firm? It is 100 million. It's been halved, right? First, is this good news or bad news if you're an equity investor? Unless you have a very perverse definition of good news, this is definitely bad news, but I have a very pragmatic question. The value of the firm has now dropped from 100 to 50 million. Remember, your equity was worth 75.94 million? Clearly, it's going to be lower. The question is how much lower? If you take the 50 million entirely off, it should drop to 25.94 million. If you listen to your accountants, they'll probably tell you your book equity is negative, so it's worth nothing. Or maybe there's a third possibility, which is it's worth more than 25.94. So really the question is, will my value of equity drop by 50 million, more than 50 million, or less than 50 million? What do you think the answer is without working through the numbers? Clearly it's going to drop. Go ahead, Lambert. Less than 50 million. You're right. But if it's less than 50 million, somebody else has to bear the pain, right? Who's the only other player in this game? The lenders. Remember they were 24.06 million? Let's see how much pain not because they want to feel the pain, but because they get dragged in. So here's what I did. I kept everything in the option pricing model the same, just change my S because it's 50 million. So all the other inputs stay the same. And when I value the equity, the value, first, let's focus on ND2. Remember there's a 37% chance of bankruptcy. Now it's 58.5%. No surprise here, right? Half the company disappears. There's a greater chance of bankruptcy. The value of the equity drops, but drops by only 45.5 million, which leaves you with 4.5 million. That comes out of the lenders. So their interest rate is now going to be higher. The value of the debt is going to be lower. I couldn't stop myself once I started. I lowered the value of the firm to 40, to 30, to, you know what I was trying to find out, right? When does equity become worthless? You know what? I could not make the value of equity disappear. It's an incredibly stubborn instrument. I lowered the value of the firm to 5 million, 3 million. Equity just hung in there. So I have a question. It's a kind of an intuitive question. What's keeping my equity value alive? I mean, clearly, this is a basket case company at 10 million or 5 million. What's keeping the equity value alive? Justin?
Just not an anomaly of the exponent.
No, give me an intuitive, but that's a mathematical. I want an intuitive reason.
The uncertainty of future cash flow.
Uncertainty, but what's the other component in addition to the uncertainty? Time. Because if the debt comes due tomorrow, all the optionality disappears, right? I have time and I have uncertainty. Do I want a lot of uncertainty or very little uncertainty? I want immense amounts of it because if you're drowning, doesn't matter whether you're drowning in 5 feet of water, 50 feet, either way, you're going to be dead. You're underwater already saying, what difference does it going to make? Bring on more water. It gave, when I did this, it actually changed the way I think about bankruptcy. Actually, my daughter, when she was 3, gave me this answer already. I should have been listening. Because when she was 3, I would play Monopoly with the 2 older brothers during the summer. And she would insist on joining in. And after the second round, I had to ban her because she was like a one-person Enron. She would take $200 without passing go. She would put hotels and properties that didn't belong to her, start charging you rent for things that didn't belong to her. I said, Kendra, you're banned. And she's a tiny little creature, but she wore a terrible time. She walks around, you're bankrupt, you're bankrupt. Very impressed, the 3-year-old using the word bankrupt. I said, Kendra, what does the word bankrupt mean? She said, bankrupt means you don't get to play the game anymore. I said, that's a very good definition of bankruptcy. Because as long as you get to play the game, you're not really bankrupt, right? Because I have 10 years to play the game. Who knows what can happen in the next 10 years? Optionality is held afloat by time and uncertainty and hoping that something good will happen. So already you can see that you can have basket case companies. And sometimes people say, how come shares in this company? Everybody knows about how come they're still trading it? They're not trading it for the dividends. They're not trading it for the cash flows. They're trading it as deep out of the money options. And you're hoping that most of the time they're going to expire worthless, but maybe. Now, I remember when now United used to be called Continental Airlines in 93, was trading at 75 cents a share. Stock was close to bankrupt. If you'd been able to buy it at 75, and you could have, that stock was trading at $53 2 years later. That's what optionality does when it pays off, is it gives you these immense returns on investment. So that's the first way you can see this play. Let's take a second thing that we talk about in almost every finance, a conflict between what's good for equity investors and what's good for lenders. So let's go back to the original firm. So pre-catastrophe firm, equity is worth 75.94 million, debt is worth 24.06, value of the firm is 100 million. I'm a project salesman. I show up at your door and say, do I have a project for you? And you say, what kind of project is it? I said, it's a negative net present value project. So what does your corporate finance training say? Shut the door in my face. No, wait, not only does it have negative net present value, it's very risky. This is going from bad to worse, right? You say, why would I take a risky negative net present value project? Let's do some magic. Let's assume you take a project which has a negative net present value of minus 2 million, and it's very risky. It'll actually raise the standard deviation of your company from 40% to 50%. This is terrible, right? Let's see what happens to the value of equity and the value of debt. So I want you to remember these two numbers, because here's what I did. I went back and I plugged the numbers into the firm with a higher standard deviation. The value of the firm drops by 2 million. That's what negative net present value does. Here's the magic. The value that I get for the equity is 77.71 million. You actually saw your value go up by almost 2 million. And guess who the real loser in this game is? The lenders go from it. This is why you should never lend to an LBO and let the equity guy make all the decisions. I've never understood when banks do this and then complain about it. What did you think would happen? That they would look out for your interests? Why would they? Left to your own devices, you're going to see this risk sharing work against you because the equity investors get that upside from having higher risk. That's why when you look at bond covenants, and we talked about, or debt covenants, when banks lend, they will put restrictions on the kinds of projects you take because you're going to take riskier projects. That's a transfer of wealth that happens, and you can see it play out in the option pricing. Let's take a third thing that we're taught in corporate finance is okay. When you do an acquisition and you pay a fair value, it's supposed to be value neutral and zero net present value investment. Yeah, I don't want to abandon that principle altogether, but I want to look at some nuance. Let's assume that you're approaching a target firm, you valued 150 million, you paid exactly 150 million for it, zero net present value. But let's assume that that firm you bought has the standard deviation of value of 50%. And remember, when you combine the two firms, the variance of the combined firm is going to reflect a correlation between those two firms, right? So if you're a conglomerate and you buy a firm in another business, the correlation between the two businesses. I know this is throwing you back to the very first foundations class, but remember the two-asset portfolio variance of a two-asset portfolio? Variance of the first asset times the weight of the first asset. No, so basically, and the third term is the covariance term. You plug that in, you come up with the variance in the combined firm's value, which is lower than the variances of the two individual firms. Now, usually investing, you say, who cares? I can diversify it away. But here you're creating a merger, and creating the merger, you've taken two risky companies and created a combined company that is much safer. Remember, you paid a fair value upfront? If I work through what happens to the value of your equity after the merger, even though you paid fair value, you're going to find that your equity decreases in value and your debt increases in value. Why? Because you've taken two risky firms create a combined firm that's safer. And if you're not careful, you're going to see wealth transferred from the equity investors to the lenders. Happens every time you have a conglomerate company being put together. How do you offset this? You know this is going to happen as the equity investor, as you combine companies in different businesses. And if you're not careful, you're going to keep transferring value to lenders. What are some of the things you can do to recapture that wealth transfer? What's the source of the wealth transfer, Mladen?
Well, in this case, this is a fact that
As a lender, why are you so much better off after the merger?
as a lender,
As a lender.
why would you be better off after?
So let's say you lend to A or B separately, and then you're looking at the combined firm. This tells you that you're going to be better off in some way. What is it about the combined firm that makes you better off?
If you have any kind of revenue or cost synergies with the combination.
But you don't, that's the upside, right? We're
Yes.
talking about risk, right?
Okay, risk.
So
Well, if you have risks, if you know, there's a heightened risk, that could be coming from, just
Something.
increased amounts of financial leverage, meaning that like it's easier for the company to dip into stress.
and also remember, you're combining two companies that were risky, you're creating a safer company. And I'm letting you keep the interest rate you charge that's where the increase in wealth comes from. You lend to a risky company, charge a higher interest rate. I'll now create a safer company and I'll let you keep the interest. Of course, you're going to be happy. So the first way I'm going to recapture it is I'm going to try to pay down my debt and replace it with new debt. The second is I can borrow money to do the acquisition, right? So you think you're ripping me off, I'll rip you off even more, right? So if I borrow money, and that's why conglomerate mergers often use more and more debt as they get bigger, is you're trying to offset that wealth transfer effect by saying, it's true the company will get safer, but you know what? I can make it riskier again for you by going out and borrowing more money against it. But left to your own devices, and it's actually a great interview question. If I paid fair value in an acquisition, will my equity be unaffected? The answer is it depends. It depends on who I'm acquiring. And it also depends on how I'm financing the acquisition. Because if I don't watch those things, I can pay a fair value and still end up with equity being worse off at the end of the game. Any questions? No, yeah, go ahead, Fiona.
So in a very extreme situation, like if company A and company B are in very different like businesses,
Will it be even better? Remember, what drives that saving is this correlation, right? That's what captures it. So if I'm very different business in very different countries, even that I can make the correlation go towards 0.1. The lower the correlation becomes, the greater the savings will be. Think about a two-asset portfolio, right? The benefits to diversification are greatest when the correlation across the two assets is low, right? So you can actually, so the benefits of doing this for the lenders will be greater and greater the more that's why I made it a conglomerate merger. If you're in the same business, this effect is going to be smaller because you're both airlines. As a lender, I'm lending to two basket cases to begin with, a much bigger basket case afterwards. I'm not going to gain much. So the more diverse the business is, the greater you're going to see this effect play out. Now, of course, the question is, can I do this with a real company? The example I gave was awfully made up, right? I gave you the value of the business to begin with, then I made one nice zero coupon bond, and then I gave you the standard deviation of the value, saying, how the heck am I going to get all of this if I'm trying to apply this to a real company? And so I'm going to direct this specifically to the very small subset of you where this will work. Because remember, for a liquidation option to have value, it's not just that you can liquidate, but that the debt is, if debt goes towards zero, and this is an answer to the question, is debt goes towards zero, the optionality comes from the fact that you're taking advantage of the lenders. If you have no lenders to take advantage of, liquidation option kind of dissipates. But to get these inputs, you're saying, how the heck am I going to do this? So I'm going to take my artificial example. There are only two claim orders. I gave you the value of the firm. I gave you the variance, and I made a nice zero coupon bond and see if I can apply it in a real company. So let's take each of the inputs and talk about how you'd come up with the S, the K, the T, the R, the sigma for a distressed company, money-losing company with a lot of debt. First, for the S, you actually done it already, right? You've done a DCF, you came up with the value of the firm. That becomes the S in the model because that basically is what you can get. And if you want to apply even a discount to it, saying if I have to liquidate it, I'll get 20% less than the S. So the S can either be valued or priced. So both techniques we've used to come up with your enterprise value, not your equity value, enterprise value, because of the S in the model. For the variance, now we're in dangerous territory. I don't think many of you have done if you've done a Monte Carlo simulation in your DCF, all the more power to you. But most of you are not going to have, that requires resources and information you don't have. So I'll give you a shortcut. Let's say you're valuing a troubled steel company. Troubled and money losing, it has a lot of debt. You've not run a simulation. You have an S, a value for the steel company. So what should I use as a standard deviation? I can help you out. I can show you what the standard deviation of a typical steel company is. How do I do it? The same way I get bottom-up betas. I take every publicly traded steel company, I observe the standard deviation stock prices, standard deviation bond prices. There's actually a data set on my website on standard deviations in firm value for different industry groups. I would strongly suggest you use that number because you're only 7 days left. And you don't want to be digging for standard deviations with all these, Monte Carlo simulations at this point in time. So if you have a troubled company, money losing with a lot of debt, take a look at the industry group, take the industry average standard deviation, use that as your standard deviation. So you got S, you got sigma. You say, what about K? In my example, it was in one nice zero coupon bond. I'll wager if you have a money losing company with a lot of debt, you don't have one nice zero coupon bond. They borrowed money from everybody who will lend them money. So you got like 50 different debt issues. Here's what I would do. Consolidate them all into an equivalent zero coupon bond. What does that mean? Take all the principal you have due, add it up, act like it's the face value of the bond. Take a weighted average of the duration, but if you're in a hurry, the maturities of the debt, let's say it's 7.5 years. It's almost magical. You've taken all this complicated debt and replaced it with one equivalent zero coupon. That maturity is also going to be the life of the option. Let's try this. You heard of Eurotunnel? It's that hole in the ground where cash goes in but never comes out. Originally constructed with all kinds of dreams about how the UK and the French government would make a lot of money in the tunnel. It's a great infrastructure achievement. I love having the Eurotunnel. You could take the train from Paris to London in 2 hours? But it's been a financial disaster. This was way back in time when it was a lesser or greater financial disaster. I don't know, it's always been a financial disaster. But in 1997, Eurotunnels had an operating loss of 56 million and a net loss of 685 million pounds. So it's money losing, right? The first condition. At the end of 97, its book value of equity had become negative. You know, why you keep losing money long enough, the book value of equity gets wiped out. Big time, long-term money loser. First check. Does it have a lot of debt? God, does it have a lot of debt? Now it's got short-term debt, 10-year debt, 20-year debt, even longer-term debt, 8.865 billion pounds of debt with a weighted average duration of 10.93 years. As I said, if you use a weighted average maturity, it'll be perfectly okay. You'll still get through. It's like 12 years maturity. No. So I did a DCF valuation of Eurotunnel and I put my optimist hat on. What does that mean? I converted the negative margins to positive margins. The debt ratio came down over time. I nursed them back to health on my spreadsheet. The bottom line is the value that I got in my DCF model is 2.3 billion pounds, and I'm in deep trouble. How much debt do they have? 8.865 billion pounds. Even with my optimist hat on, what am I getting as the value of the firm? 2.3 billion pounds. There are some of you in your DCFs who had this happen, where you came up with the value of the operating assets. It was actually less than the debt. And you said, what do I do now? And I said, hang in there. There's help coming down the pike. There it is. Basically, you got an option. Is it now? It's an out of the money option, a deep out of the money option. If I asked you from an intrinsic value standpoint, how much should you pay for this equity? Your answer is, are you crazy? Why would I pay for this equity, right? But think of it as an option. You're buying this, the equity in this company. It's deep out of the money. What's the one thing you have working in your favor? The debt doesn't come due for a really long time. What might happen? The Sultan of Brunei might show up and say, I'd like the tunnel named after me. I'll pay you 20 billion. Not so. But All kinds of things can happen in 10.93 years. So here's what I did as my final input. I needed a standard deviation. And here I tried industry averages, but I very quickly had to give up. There weren't very many. Now I have a shot. There are actually toll road companies and infrastructure companies. There I actually had to compute a standard deviation in firm value for Eurotunnel as a company. So I started with the stock price standard deviation, which is 40%, 41%. I got a standard deviation in Eurotunnel bonds, which are publicly traded, 17%. And here's the messy part, because the stocks and the bonds don't always move in perfect correlation, the standard deviation in firm value uses that two asset portfolio again. Stocks, 15%, bonds, 85%, and the correlation between the two. The standard deviation in firm value is 0.0335. I'm pretty much there. That's going to become my variance in value. And the 15-year bond rate is 6%. Yes, yes.
Correlation.
Because they're both traded, I just computed the correlation. So I downloaded the weekly prices on both and did the correlation. This is why I said, don't go that way for your company. This is a nightmare. Just use the industry average, even if it means stretching the definition of industry. Yes, David.
If they managed to raise debt, because I mean, at this
A lot of it was raised at the time that they built the infrastructure when hopes were high, right? That you could do all kinds of neat stuff with the Eurotunnel. But there's another reason why they can keep raising debt, which is the British and the French government have a vested interest to make sure they don't go bankrupt. So there's almost like you have an option where the life of the option keeps getting stretched, but the government's working to make it less likely that you'll be forced into liquidation. So I have the inputs. I put S, K, R, T, and sigma, and I come. Remind me again what the likelihood, in this case, what's that model telling you about the likelihood of default? It's about 92.5%. No surprise here that this company will probably default. But here's the magic. This is about as a basket case I've ever valued. But the equity, I told you it's an incredibly stubborn instrument, was trading at 122 million pounds. You do DCF, saying there's no way. You do a pricing, there's no way. What multiple are you going to use? But from an option perspective, you're still willing to pay for the equity. Why? Because if something good happens, the 122 can become 500. It's going to be an incredibly volatile piece, but the advantage is with limited liability, it can't go below zero. You can see already why. You've heard of vulture investing. Vulture investing is when you pick deeply troubled companies and you take positions in either the equity or the debt. The equity positions in particular, you just have a lot of out of the money options in a portfolio. So if you're going to buy deep out of the money options, think about what kinds of distressed companies you would like to buy as a vulture investor. You ready? I'm going to throw the choices at you. So you're looking at a bunch of distressed companies, and I can come up with a list on Capital IQ. They have a lot of debt and they're losing money. Do you want high variance distressed companies or low variance distressed companies? High variance. You don't want a stable distressed company. I'm not even sure what that means. I can lost 100 million last year. I can guarantee I'll lose 100 million every year. You want high variance. You want companies with more long-term debt, or if I gave you the maturity, or shorter-term debt. So you want long-term debt in risky companies because that's where the optionality is going to be greatest. Yes, David.
but all that is going to be priced in. So if there's lower variance, that the stock price is going to be lower, so maybe you better buy like.
Yeah, it's a fairly, so it is, so if you do the option pricing and you look at the actual price, then you can do, right now, you're not even comparing, right? You have a low price, I can tell you it's a low price, but now you can say this is what the price should be with an option pricing model. And maybe it's priced and maybe it's not. Maybe they're all fairly priced, in which case you walk away. But that's basically what because there's nothing else to compare to. You can't compare the intrinsic value, you can't compare it on any multiple. This becomes the only basis for the comparison. So in closing, there are options everywhere. Most of them are not worth your time or your energy because they're not worth much. Let's start with that proposition. Most of the time when people talk about real options, my reaction is, show me, where's the exclusivity, right? And when there are options with significant economic value, not all of them can be priced with option pricing models very well because you can't trade the option, you can't trade the underlying asset. Already you can see that this is a process But the insights you get from option pricing model can help you as a distressed equity investor, but perhaps you won't be using option pricing models yourself to actually value the equity. Though with distressed equity, the variables are actually observable. The underlying asset is traded. So basically you can get the trading, you can actually, so if you are creating a hedge fund to do arbitrage, you can use this as a way of creating that arbitrage by buying the underlying stock and selling short the replicating portfolio. Yes.
Is it empirically proven it's like accurate?
Yeah.
All this just.
Yeah, in fact, how would you test? Let's suppose you want to do research. No, I'm saying it is testable because take stocks with low price to book ratios, right? Then bring in the standard deviations. I would hypothesize, and I did this a while back. I mean, I've never had the energy to go back. I would hypothesize that companies in high variance sectors with a lot of long-term debt should trade at higher price to book ratios than, when you look at distressed companies and companies which don't share those characteristics. So you could look at price to book ratios of distressed companies and run a regression against standard deviation and the maturity of the debt. And that when I ran it, had that relationship you'd expect from option price. Whether I'm willing to take that the next step and actually invest on it, it's not my game. But if you're a vulture investor, this is your entire game. I would assume that you'd bring in the ammunition to do the rest. Which brings me to acquisitions. By now, if you've been in my corporate finance class and my valuation class, you know what I think about acquisitions. More money is destroyed through acquisitions than any other single corporate action. But banks love it, consultants love it. Why? Because this is where the fees get made. So a few years ago, about 20 years, not even a few years ago, 20 years ago, a student of mine who started running these seminars for top managers. And, he was running something in New York and he said, I'm doing a one-day session on acquisitions. Will you come in and talk? And I said, who's in the audience? And he said, for lack of a better word, he said, CFOs of serial acquirers. Serial acquirers are like a book of the month club. They do an acquisition every 2 months or 3 months. That's how they. And I said, are you sure you got the right guy? I mean, it's, these people love acquisitions and I don't. And he said, no, for the rest of the day, they're going to be hearing from bankers and consultants. And I'd like you to come in the last 30 minutes and tell them what you think about acquisition. I said, okay. I came in and put up my first slide because it kind of brings home what I think about acquisitions. I titled it Acquirers Anonymous, 7 Steps to Sobriety. Because in my view, acquisitions are an addiction. Because once you start as a company growing through acquisitions, you can't go back to taking projects. It's so much work to take $50 million projects. It's so much easier to do. And think of the ego boost you get and the glory that comes with the acquisitions. It's other people's money. So I'm going to start with the bad news on acquisitions, and it's a lot of bad news. So get it out of the way first. If you look at the acquisition process, there's the acquiring company and there's the target company, right? There are shareholders in the acquiring company, there are shareholders in the target company, there are bankers in the acquiring company, there are bankers in the shareholder. Let's look at who the winners and losers in the game are. First, let's take the 2 sure winners out of this in this game. The bankers. I said, you're going to get the deal fees. Good deal, bad deal, doesn't matter. So let's take them on. Let's look at the shareholders in the acquiring company and the shareholders in the target company. This graph brings out those divergent effects. The blue line is the share price. So this looks across all acquisitions around the announcement date of the acquisition. So if you see the line drifting up, that means your stock price pops up, your line drifting down. So on average, if you look at the acquiring company's stock price after the acquisition, you get a drift down. If you look at the target company's stock price, you don't get a drift up, you get a jump up. At first reaction, you think, but target companies make so much more. This should be good as a net plus, right? But what am I missing when I say that? Acquiring companies tend to be much bigger than target companies. At 3%, the day Microsoft announced the Activision acquisition, Activision stock price jumped 25%. Microsoft stock price dropped 3%. But that 3% drop in Microsoft stock price was bigger than the 25%. The net effect actually turns out to be negative. But clearly, if you're going to be one of the players, you want to be the target company shareholder. You're celebrating, and everybody else is going to think, what happened here? when you show this to, when I presented this to the the serial acquirer CFOs, their defense was, that's what happens in the announcement day. They don't see what we see. You know who they are. That's shareholders in the market. They don't see what we see. What do we see? We saw those tables with synergy that the bankers showed up and all this neat stuff. We haven't, and that's true, right? The CFOs and CEOs have more information about the merger. So as a follow-up, I said, maybe the market's getting it wrong and you're right, because if I trust you guys on whether an acquisition creates value, 100% of acquisitions should create value. But the market seems to be saying that's not the case. So there have been several studies that have looked at acquisitions 5 or 10 years later. That should give you enough time to show me that the acquisition. And these studies routinely come back with the same results. McKinsey did a series of studies where they looked at, do you earn more than your cost of capital? Kind of a fundamental question in valuation. And they found that most acquisitions, what you invest in the target company, don't make your cost of capital back. KPMG actually did a study of like thousands of mergers around the world. And they found that in more than 80% of these mergers, there is no synergy, that there's actually reverse synergy. And that synergy never shows up. And here's the most damning statistic. Half of all acquisitions are reversed within 5 or 10 years of the acquisition, which is the ultimate admission of, guys, it didn't work. The evidence on acquisitions is damning. There's a small slice of good news. I'll hold it off to the end. But if you look across acquisitions, especially big acquisitions of public companies of each other, there is no evidence that any of this pays off. And there's a lot of evidence that acquiring company shareholders lose. Now, in case you're thinking this is restricted to the US, think again. This is a disease that's spreading. Until about 20 years ago, if you're an emerging market company, you're always the target company, right? You didn't have the money to go buy an acquiring company. And over the last 2 decades, many of these emerging markets have become wealthy enough that they're now the acquirers. And in many of these, in the countries from which these companies come, this becomes a source of patriotic pride, right? Tata Motors is buying Jaguar Land Rover. We've arrived. I have mixed feelings about this because you seem to take on all of the same characteristics of US acquirers. This is actually from a study of Indian acquirers. And initially, markets like it. You see the stock price go up. And then over a period of months, you start to look at the facts and you say, guys, you paid too much. So this is not just US. This is an M&A problem that's around the world. And and it's a problem that I think if you look at collectively, that acquiring companies tend to pay too much for target companies, overestimate the value of synergy, have a difficult time delivering on their promises, and there's zero learning built into the process. You know what I mean by zero learning? Is you think that you'd get better over time, right? You've learned, you have all this data, it doesn't seem to change. And what that tells me is there's a structural problem in acquisitions that's creating these, that no matter how many lessons and studies you see, that's not going to go away. David?
What's the difference between this and what you were talking about a few months ago about the PE buying a private company and cost of capital is lower, diversified? Like, why is it?
That's the, so we'll talk, this is public and public. Public and public, this will never work. We'll talk about the subset of acquisitions where they create value. And one of the subsets is in these cases of public companies buying private companies, rolling up. There's a limit to how much you can do it because you get too big to be able to do it, as Cisco got. But that's one of the few pieces of good news is there are pathways to creating value, but it requires discipline and it requires knowing when to stop, both of which are really difficult to instill in a company. Right? But for the most part, look at the big acquisitions, look at the dollar values, 90% of the acquisitions come from public to public. They don't come from the public to private space. Yes?
This actually might just apply to the public to private, but what is like the case where it's like preventing, or like monopolies that want to prevent competition?
Yeah, we'll talk about defensive acquisitions. And I think that once you start playing the defensive acquisition game down, not so much a monopolist. Monopolist doesn't have to worry. But if you're in a competitive sector and say, we don't do it, they will. So we're going to do the acquisition. You're in a bad business to begin with. You're just going to make it worse. So we'll talk about that because that's one reason I hear from CFOs that we have no choice. We have to do an acquisition. So here's what I'm going to do. I'm going to talk about what it is in the process that goes wrong, starting with purely mechanical issues that I see all the time in acquisitions. First is what I call risk transference. It's something we talked about in the various first to second week when we talked about Kennecott buying, you remember that acquisition? Where a safe company buys a risky company, and what does it do? It uses its cost of capital to value the risky company. And if you do that, the consequence is going to be obvious. Every risky company is going to look cheap to you because you apply. So we're going to talk about risk transference, where it can lead you as an enterprise. Second, I want to talk about debt subsidies. What does that mean? You're an acquiring company of a AAA or a AA rating. You're able to raise money at a really low rate. Let's say you decide to do an acquisition and use your debt at a low rate to fund that acquisition, and you put that low cost of debt into a cost of capital. You know what's going to happen, right? Your cost of capital is going to be lower. The value for the target firm is going to be higher. The question I'm going to ask is, should you be paying that as a premium? And if so, who's paying for it? Third, I want to talk about control. Remember that card I pulled out, control 20%? I'm going to go back and talk about where the 20% came from and why it's one of the most deadly numbers in acquisitions, because it will always lead you to pay 20% more than the market price. Yes?
The opportunity cost for acquisition is for a company to do it in-house, right? For example, if
No, the opportunity cost, you can give the cash back, right? Remember, there's a third choice. You can take it in-house, you can do an acquisition, or you can just give the cash back because you're in a bad business. So are you?
assume that they're not bad.
Okay, so you're in a good business. You can either do the project, so then it becomes a pure NPV.
And markets, if you say markets prefer companies.
No, it's got nothing to do with markets. It's what you pay upfront. What is the difference between doing an acquisition and an internal project? What do you get in an internal project that you give away in an acquisition, especially if it's a publicly traded company? In an acquisition, you have to pay market price plus. So let's suppose you're buying a really good AI company, right? The market knows it's a really good AI company. It's already priced in. What do you have to do? You have to pay a premium on that price to take the investment. Do you see how you've upped the ante? The upfront amount you have to pay in an acquisition already reflects market expectations plus an extra 20%. And you now have to beat that. Whereas if you were building an AI project from within, you'd require money and it might require resources. It might take 3 years to do. But you control the resources you put in and how much you spend. It's one reason Microsoft, to enter the cloud business, built its business from within. Azure was built from within. It could have been much quicker for them to go buy a cloud company, but then you'd have paid, $6 billion plus, and now you'd have to beat that. So that's effectively what makes acquisitions more difficult. And that's why it said more difficult with public companies. The private company, at least you have a shot of negotiating. Here you start with the market price plus. So third is autopilot control, the 20%. We'll talk about what the true value of control is and how to put a number on it. Fourth, synergy, right? Some magical word gets thrown around all the time. And people pay billions for it. And here's the scary thing. We ask them, what's the value of synergy? You know what the response is? Too fuzzy, too difficult. And you said, did you pay in fuzzy dollars? You pay in real dollars, it's your obligation to try to estimate the value of synergy. Fifth, there's a pricing argument to be made. How do you justify an acquisition? You price the target company. There's nothing wrong with pricing, but I'll talk about how target companies get priced, which leads to skewed samples and bad pricing. So it's not just that it's pricing, it's bad pricing. Six, and I think we've got to face up to the reality that one of the biggest challenges in acquisitions is the decision gets made first. And then the valuation follows. You know what I mean by that? Company decides it's going to do the acquisition, then comes looking for affirmation. Tell me I'm doing the right thing. This never works out in life, right? When you've decided already, my kids used to do this all the time. Dad, I've decided to do this. What do you think? So why do you want to know what I think? You've already decided to do it. Yeah. But a lot of acquisitions, the CEOs decided this is the acquisition and they're going to do it no matter what. And finally, it drives me crazy when you see acquisitions that are $50 billion acquisitions fail and nobody loses their job. The same company where you have $50 million project and you do it badly, they get fired. it's almost like the Peter principle working out here, which is, you know, you rise the level of your incompetence and there's no accountability in this process. So let's get this show on the road. In fact, when I did my Acquirers Anonymous, I made the CFOs with each test. So I'm going to pass you through a series of the very simplistic example. And I said, just check, put a check if you've passed the test. And promise me that if you fail more than 2 of the 7 tests, that you will stop doing acquisitions. None of them took me up on the challenge. But you guys are not in acquisitions yet. Some of you might be thinking about it. So if you want to try this test to see if you want to go into acquisitions or not, you're welcome to. Because you have the ammunition to get every one of these tests right. So let me start with a very simple target company. I don't want the math to become this burden. So let's start with a simple target company. It's a company which has revenues of 100 million, operating income of 20 million, after-tax operating income of 12 million. 0 growth in perpetuity, and has a cost of capital of 20%. It's all equity funded, but the cost of equity, the cost of capital at 20%. What's the intrinsic value of this company? Fiona? Seems like I haven't given you enough information, right? I've given you after-tax operating income, but I haven't given you CapEx and depreciation. Why don't you need that? What's their growth rate? 0, right? So reinvestment rate is 0. So the free after-tax EBIT is going to be the free cash flow of the firm. So it's 12 million is their free cash flow. Your discount rate is 20% of 60 million. You know what my job is going to be? To try to convince you to pay more than 60 million. So I'm going to throw a series of things at you and you tell me what the flaw is, what I'm trying to get you to do. So we've got an intrinsic value of 60 million. You're an acquiring company. You say, guys, you're an acquiring firm. Your cost of capital is only 10%. What's the value of the target company? You know enough to not fall into this trap, but you see where I'm leading you, right? 12 million after-tax operating income. If I discount back at a 10% cost of capital, would give me 120 million. There's a 100% premium right there. So the first lesson we want to take away is you can't transfer your risk characteristics to the target firm. The fact that you have a 10% cost of capital is completely irrelevant. When you value the target firm, don't even bring the acquiring firm into the game. It's all about the target firm. I remember about a long time ago, it was when GE was at its peak and Stanford was where the world revolved, right, with the headquarters. So they asked me to come and talk to their divisional heads about acquisitions. So I took the Acquirers Anonymous. I get to this slide. I look around the room. There are like 50 divisional heads, and they're all looking a little sheepish. And they say, you don't do this at GE, do you? They said, do what? Take GE's cost of capital, go around valuing random target companies. They said, we do, but it's okay. I said, what do you mean it's okay? They said, we're so big and they're so small. It probably doesn't matter that much. I should have brought, the best thing to show that this is not true is to bring a Krispy Kreme donut, cut it into 24 small pieces and say, now eat the 24 small pieces. How many calories do you think you get? Making the 24 small mistakes, it adds up to one big mistake. There's no excuse for doing it, but half of all M&A, so if you go to M&A, keep your eye on it. Half of all M&A, the acquiring company's cost of capital gets used. And you know why? Because it's called cost of capital. You think of it as a cost of raising money. The cost of capital is an opportunity cost. It should be based on the riskiness of what you're not discounting, not what it cost you to raise money. Maybe we should have called cost of capital something else right from the beginning, because people are operating under the illusion, if this is what it cost me to make money, why can't I use it as a discount rate? Because the risk is different. So that's the first. Are there if any of you have issues, get it out of the way now, because I don't want to see your acquisitions 10 years from now with the acquiring company's cost of capital showing up, because I will have to take you off. I'll remove your grade. Take you off the list. I'll put you into the corporate strategy class. You'll still graduate. You get an A in corporate strategy. Yeah. So everybody okay with that? Let's take the second test. Let's assume you plan to fund half of this acquisition. So you've agreed with me, 20% cost of equity. So I've managed to convince you. But he said, no, but you know what? Half of this funding for this acquisition is going to come from debt. We are a highly rated company and it costs us only 4% after taxes to borrow money. You see why this is leading, right? What do we do in cost of capital? We take a weighted average. I've already given you that I'm going to use 50% equity, 50% debt. The equity, let's say, even if you leave the cost of equity as is, you're supposed to unlever it and re-lever it, but let's leave it at 20%. Half your capital comes from debt at 4%, half comes from equity at 20%. The weighted average at 50-50 would be 12%. 12 million divided by 12% gives you $100 million value. Mechanically, you've done everything right. You've taken the weights, you've taken the cost of debt, the cost of equity. But what's wrong with what I've just done of using my cost of debt as the acquiring company to come up with this lower cost of capital?
I mean, it's the same as the first one, but with debt.
In this case, there's a simple rule in acquisitions: render unto the target shareholders that which is theirs and not a penny more, right? Think about where this debt capacity came from. It came from the fact that I'm an acquiring company. I've accumulated debt capacity. I'm borrowing money against the debt capacity. That extra 40 million has nothing to do with the target company. I'm getting it simply because I've funded it with my debt that's cheap debt. It actually reinforced my earlier point. When you have to value a target company, don't bring the acquiring company's cost of debt or debt capacity in, even if you're funding the acquisition entirely with debt, and perhaps especially so. Act as if the target company would have to raise money on its own. Look at the mix it can afford to have, which might not be more than 20% debt or 10% debt or no debt. Compute the cost of capital. And if you choose to do the acquisition with debt, I'm not going to stop you. But that's not creating value through use of debt capacity. Sure?
You're saying not to use it because it's like not something that the target has.
Exactly.
But would you consider that to be like what they call synergies, right?
That's nothing to do with synergies, right? Basically, you're taking a negative net present value project and you have debt capacity that's covering up the negative net present value. Right? The minute you take this project, if this company acquire this company for 100 million, you got minus 40 million. You got tax benefits on the debt that exceeded the 40 million. But guess what? Those tax benefits could have been used to just buy back stock, pay a dividend. So you didn't have to take this project. And the fact that the benefits you got exceeded the negative net present value doesn't make it a good project. It's still a bad project. Talk about control premiums. You know how bankers came up with the original 20%, right? I'll give away how the sausage gets made. There's this database called MergerStat. It's been around a long time. It's a great database. It includes every merger transaction of public companies that happens in the US in one database. So it gives the name of the acquirer, the name of the target company, the market value before the acquisition, and the market value at which the deal got done. And then it gives you the premium paid on each acquisition. So looking across time, across thousands of acquisitions, roughly speaking, the premium is about 21, 22% over and above the market price. Bankers love rules of thumb, right? So when they talk about control premiums, they're taking that average premium of 20% that gets paid and say that's a control premium. Pushback. It could be a control premium. What else could it be a premium for? Even in the best case scenario where mergers are justified. It could be for synergy, right? It's in there. And of course, if it's bad merger, it could be for stupidity, because you overpay, it's got to go in there somewhere. It's a silly way to attach a premium because even in the best case scenario where companies pay fair value, that 20% is for everything in a merger, including synergy. But, that's often the justification. You came up with a 60 million, pay a 20% premium. Everybody else does. It's a control premium. So let's push back and talk about the value control. We kind of introduced this concept early in the class. Let's flesh it out. Now, let's suppose this company is badly managed and badly run. What does that mean? Its costs are too high, its margins are too low. And you believe that if you run this company right, you could improve the margin from 20 to 30%. Go back to that example, right? So instead of 12 million now, as after-tax operating income, you're going to make 18 million. Instead of 60 million as a value, you're going to come up with 90 million. The value control is going to be 30 million. But let's think pragmatically. You're the acquirer, you valued control. Yeah. Would you pay the 90 million upfront? If you do, what have you effectively done? You've effectively given the target company shareholders the entire 30 million increase in value. You're going to do the hard work of fixing the costs, doing all, and you get nothing because you paid the 90 million upfront. So first, there's two-part process. Valuing control requires that you tell me what you would do differently. And the second part of the process is you set up a way in which you can negotiate to get at least some of that value of control for yourself because you're going to do the dirty work. And if this company were already perfectly managed and perfectly run, the value of control is going to be zero because what the heck are you going to do once you get the company? Okay. Gandharv, question?
Yeah, what if there's a bidding war of sorts and there's competition among bidders?
Let's say you're an eBay. You're bidding for a card. You wanted to pay 50. It's now at 80. And then you're at 90. Then you're at 100. What's the best place to be in a bidding war? Is to be the loser of that bidding war. Because if you win a bidding war, there's in the economics, it's called a winner's curse. There's a time to drop out. The reason and you know what? To be able to drop out, what do you need? You need a reservation price. If you get into a bidding war here, you're going to start at 60, then you go to 65, 70, 75, you're still in there, right? And then it gets to 90. And the other guy bids 95. You're out of there. Right? So it's true in a bidding war, the target company is going to get much of the spoils because you have no choice. But if you pay the 90, be very clear about what you took a zero net present value project. And if this is the way every acquisition plays out, you're going to be doing a lot of work for very little to show, right? So once in a while, if you run into a bidding war, it's okay. But if acquisition after acquisition, you get into bidding wars and the value gets pushed up to reflect the value of control, there's nothing you're going to gain.
So in this
But
case, where would you draw a line? Let's say
90.
if I had 90.
Yeah. 89.95. I'm still because think in pure net present value terms, as long as I buy it for less than 90, I'm getting a positive net present value. Right?
But why would I take a zero NPV project?
You don't. That's why I'm saying if that's what happens. But maybe you do 50 of these every year. And 5, you might end up with zero net present value. It's part of your strategy. You build that in. But when all 50, you end up with zero net present value, you're doing a lot of work for nothing. Right? Yes.
Then don't you have to factor in the expenses that the acquirer has? So then that free cash flow.
Yeah, so from that, you got to take out your banking fees. There might be costs to making these changes. All of those have to be netted out. So the 30 might be the upper end of the value of control. And what if it'll take you 2 years to make these changes? Right? Then you got to take the present value of 30 years. So 30 is in a sense your best case scenario with no other cause. You get it instantaneously and everything from there will be a step down. And sometimes companies are not realistic about how long it takes to institute change after they acquire another company. So be careful. There are all these rules of thumb in acquisitions. I don't know where they come from and where they're going. And I know why bankers use them because it's not their money. They can make up the synergy premiums, control premiums. But if you're spending your money as the acquiring company, yeah. And often they will back it up with data. That's what's scary. They say, look, merger stat data, everybody 21 point, and they will add it 2 decimal points, 21.35%. You're getting a bargain at 20%. Always be skeptical about data and ask the questions about what exactly is this premium for? How can you claim it's just for control when in fact you're talking about synergy and all these other motives for acquisitions? And if you've done your valuation right, the premium should already be in there. There should be no percentage added on. The 90, once you get that, is the 90. I'm not going to add 2% premium or a 5% because it's not going to work. Any questions on control? So I've given you the ammunition. You will run into this 20% crap sooner rather than later. Actually, I did this for the Delaware court judges a few years ago because I wanted to give them the ammunition when that banker gets up and says a 20%. I don't know whether they carried it through. I have to do another session for them soon, probably, because that would be the ultimate. You get usually it's that the managing director who really doesn't know much about the numbers. The only thing he can say is the surface stuff. Is you need some pushback on this. This is absolute nonsense, but it's become part of established practice. Synergy. Magical, right? I'm going to give you my definition of synergy. And as Dor pointed out, a lot of things get lumped into synergy. And this definition is going to allow you to separate synergy from control and synergy from other stuff. Synergy happens when you bring two entities together and the combined entity is able to do something that the individual entities could not have done on their own. That's key. So if you take over a target firm with factories that are inefficiently run, you run them more efficiently, that's not synergy, that's control. You say, why are you separating the two? The way you negotiate for synergy is going to be very different than the way you negotiate for control. With control, with the bidding war, you're going to be willing to give almost all of it away. With synergy, remember, you're as key to this process as the target company. You shouldn't be giving away 100% of the synergy to them because you need both entities together. So the essence of synergy is two companies coming together are able to do things they could not have done as individual companies. So let's assume you're told in this merger that bringing this target company together, the acquiring company, will create growth and cost synergies for the combined company afterwards. It's an obvious question. Is there synergy? Obviously. Can you value it? You better be able to, because you're going to pay for it up front. So when you think about synergy, it's clear that you have to put a number on synergy because that number is going to go into you have so many pockets now, right? You have a control value, you got the synergy value. Remember which pocket you put what number in. But the synergy, you definitely should be negotiating for a share of it for yourself. So let's talk about the value of synergy because the way you value synergy will depend on what form it takes. Synergy, broadly speaking, can be either operating synergy or financial synergy. Let's start with the easiest synergy to value. It's cost synergies, economies of scale. Two companies in the same business come together. They can shut down overlapping distribution systems, whatever, costs are, and save costs. Why is it easy to value? Because you take the two companies, you value them 11% margins, and then you take the combined company, if it's able to cut costs, you say, how much will my margin change when I cut costs? That's going to increase value. The tougher synergy, operating synergy to value is the revenue synergy. Revenue synergies can show up as either higher returns on capital or higher reinvestment rates. So basically, as a combined firm, you're able to earn higher returns than you were as individual firms. Why? Because you're in a stronger competitive position, maybe in your sector, or you're able to find more projects as a combined company. See, the metrics, I'm focusing on metrics that we use in DCF valuation: higher reinvestment rate, higher return on capital, higher growth, higher value. So operating synergies either have to show up as higher margins through cost cutting or higher growth through reinvesting more, reinvesting back. They might even show up as longer periods of excess returns because you've built up comparative barriers there. But I'm looking for a number to change in my valuation. I'd love to tell you that most synergies and acquisitions are operating synergies, but they're not. Most synergy and acquisitions are financial synergies. I'll start with the synergy that should never be talked about if it's a reason for your merger. You know what I'm talking about? If you're going to save on taxes, don't ever talk about taxes. Talk about strategic factors, cost cutting. I'll give you an example. A few years ago, Pfizer, this was about 10 years ago, announced they're going to merge with Allergan, it's 2015, and move their headquarters to the UK. You know why they were doing it, right? At that time, the US corporate tax rate is 40%, and global income got taxed at the US tax rate. So almost instantaneously, you would save on taxes because the UK taxes based on only the income. So you pay local taxes everywhere. And they do this. And then, everybody knew this. And then the CEO of Pfizer was on CNBC. The CNBC reporter says, why are you doing this? And in a moment of immense stupidity, this guy says, we're doing it to save on taxes. Thinking. Because you could see what was coming, right? The minute you say that, everybody pops up. They're saving on taxes. Politicians start talking about it on the Senate floor. And within 2 weeks, Pfizer had to withdraw from the merger because the backlash they got was so intense. So here's my advice. Talk about everything but taxes, even though taxes are the only reason you're doing this. Because taxes can save you in mergers in multiple ways. money losing company and a money making company come together, you save on taxes right away. In some mergers, you're allowed to write up the assets of the book. In fact, after acquisitions, you have this game where accountants come in and reappraise the book value of your assets. To the degree that they can write up that book value, you can get higher depreciation, higher tax benefits. And there are some countries where tax laws are such that you gain from mergers. Brazil is a classic example because they have an interest on capital as a tax reduction. It's unique because they take your book equity and they multiply it by an interest rate set by the government, and you're allowed to claim it as a tax reduction. So when you do a merger, your book equity gets higher. You almost instantaneously get more tax reductions and more savings. There's tax savings. You could also combine two companies that by themselves couldn't borrow much money. It's not that they don't want to, they've hit their capacity. Why? Because they're risky. The combined company is safer. It might be able to borrow more. And finally, diversification. You start every finance class, and what are you told about diversification as a reason for mergers? Not a good idea, right? Why? Because your investors can do it themselves. And that's absolutely true. Any company that goes out and does acquisitions because they want to be more diversified, your reaction is, when I call my broker, I never pay a 20% premium. You are. In what ways is that? But here's the exception. If you're a private business, remember we talked about total betas? Remind me again how we get total betas. I know it was in the third quiz. It feels like a long time ago. We take the market beta and we divide by the correlation with the market, right? So if you're a company, if you're a private owner of an entertainment company, and entertainment companies have a correlation of 0.3, you divide the beta by 0.3, you're going to almost more than triple your beta. Let's say this entertainment company goes out now and buys a chemical company. Say, that's very strange. Why wouldn't it? You want to get as different as you can. It goes back to what Fiona said. You combine the two companies. That combined company is now going to have a correlation that's higher than 0.3. And in fact, as you build up this private company to look, let's say you make it a conglomerate, you buy private company after private company in different businesses. Over time, the correlation is actually going to creep up towards 1, which is why if you look at every family group, which has been around a long time in Asia, and you look at what businesses they're in, you know what the answer is? They're in everything. It's survival that drove them there, because by doing that, you remove that private company discount by just diversifying across businesses. So we'll stop there. When we start on Wednesday, we're going to complete the rest of acquisition. And I want to talk about changing value. What are the levers we have for changing value? Which is really, if you're going to consulting, that becomes your job, is how do we change valued companies? So we'll see you on Wednesday.